I'm Craig Popp with Accrue Wealth, and this is your first quarter 2024 market commentary. After a strong return in 2023, U.S. equity markets continued to rally in the first quarter of 2024, with the S&P 500 index climbing to another record high to close out the quarter, notching a total of 22 new all-time highs to start the year. Optimism for a soft landing, a solid fourth quarter of 23 earnings season, and continued AI euphoria led the market higher. Returns were broad-based among sectors as 10 of 11 S&P sectors posted positive returns, with healthcare, financials, industrials, materials, and energy ending the quarter at all-time highs. The past 2 years were difficult for investors as you patiently waited for your accounts to reach new all-time highs. It took over 500 trading days for the S&P 500 to surpass the previous peak it set on January 3rd of 2022. While this may feel like an eternity, remember that it took over 1,000 days to break even from the 2002 and 2008 market corrections. Next, I'm going to deviate from my traditional comments about recent performance to promote the long-term compounding power of the market. During the first quarter, there were two notable milestones. First, 2024 is leap year. This February included another day, the bonus day that we get about once every 4 years. The last leap year occurred in 2020. Just around the time the global economy was beginning to be impacted by the COVID-19 pandemic. The economy and the financial markets have experienced a roller coaster the last 4 years. In February 2020, the 19th to be exact, the S&P 500 climbed to an all-time high of 3386 before plunging over 34% as the world economy shut down due to the pandemic. If you were fortunate enough to buy at the market bottom on March 23rd, congratulations. You have achieved a greater than 100% return on those dollars. If you are less fortunate and purchased at the high on February 19th, you still have achieved a solid return. Don't fool yourself with hindsight bias. Few investors were willing to commit capital at the depths in March. And keep in mind, during this stock market recovery, you have experienced your fair share of volatility along the way, with 14 5% pullbacks, 3 10% pullbacks, and a bear market in 2022, which we define bear markets as a decline of 20% or more. The second milestone was on March 9th. 15 years ago, in March 2009, the market bottomed, ending the worst bear market since the Great Depression. Since then, the market has achieved an incredible 16% annualized return. But what if you were unlucky and bought at the market peak on October 9th, 2007? Well, after surviving a 50% drawdown, you are still up more than 350%. As I have said repeatedly, time in the market is more important than timing the market. Turning to fixed income, the Bloomberg U.S. Aggregate Bond Index declined for the third time in the last 4 quarters. The index fell as Treasury yields increased along the curve amid resilient economic data, slightly hotter inflation prints, and as markets reprice expectation for Fed rate cuts in 2024. At their March meeting, the Federal Reserve held the federal funds rate steady for the 5th consecutive month at a range of 5.25% to 5.5%. The committee stated they are seeking greater confidence that inflation is moving sustainably towards their 2% inflation target. The Fed does continue to see 3 25 basis point rate cuts in 2024, but one cut was removed from each of the 2025 and 2026 projections per their dot plot. Despite the volatility, the exciting story remains in obtainable high income levels for bonds as yields are elevated in diverse products across the yield curve. For example, high quality corporate bonds boast higher yields than have been available for nearly 2 decades. Longer-term municipal bonds benefit from an upward sloping yield curve, providing attractive tax-equivalent yields for high earners. The notable event, at least to me, in fixed income land is the inverted yield curve. An inverted yield curve shows that long-term rates are less than short-term rates. Inversions are unusual because as lenders, we typically demand higher interest compensation for locking up our money for longer periods of time versus shorter periods. This closely watched recession indicator has been inverted since July 2022 as restrictive Fed policy keeps short-term maturities elevated. The current period of inversion, which is about 440 days, marks a record length of time this spread has been inverted. Market pundits like to use this measure as a recession indicator. And I like to say that the inverted yield curve has predicted 8 of the last 5 recessions. Last year shows the danger of making dramatic portfolio decisions based upon economic measures. Instead, we focus on diversification and a risk profile that will help you achieve your goals. Thank you for your trust in us. Contact me if you have any questions.